Today we are looking into the future of Zillow Stock. We are looking into the earnings report, have a look at what management is promising us and how that translates into the numbers using a discounted cash flow model to predict where Zillow Stock or the price of Zillow Stock might go in the future. Let's get straight into it. So we just had the Q4 earnings report released for Zillow, and then if you haven't noticed or if you haven't read in the news, they had a 180 flip of sort of direction of the company, as the company was previously getting heavily into buying and flipping homes, and they have since Q3 basically announced that they're gonna go out of that business, as they just have said that they couldn't make much money out of it. So basically making a 180 degree switch, winding down that business, and then basically going into, just focusing on their IMT, internet media technology. So basically their advertising and their platform business. Which now in the Q4 earnings report is a big focus here. So we have that new so-called the housing super app. That's the vision of Zillow and how they're gonna, capture a lot of market share and make money in the future. So we basically have one super app taking care of all the hassle that comes with buying a house, such as rent, pre-approval, in-person touring, buying, financing, and selling as well. So they just want to deal with that whole transaction as such, not with actual making money on the gain of the houses. So they're not flipping houses anymore. They're just basically the one-stop shop for you to sell or buy your house. And having a quick look at the income statement of Zillow, we understand why management has actually backed out of that business, because here we have an overview of revenue and costs for the last 3 years. We see that the home segment, which is the home flipping business that they just exited, it has generated 1.3, 1.7, and then 6 billion last year in 2021, which seems to be an impressive growth rate. And you would ask yourself, well, that's the majority of the revenue. Why would they back out of that? But then if you look at the actual revenue number for that segment of homes, you see that in 2019, they barely broke even. In 2020, they made a small profit of 100 million. And then in 2021, they actually lost 100 million on that business. So there was zero to no margin at all. And they just basically, after years of trying, they have basically came out and said, okay, we acknowledge that we might not have the right algorithms or the right capabilities to flip houses, as it's such a niche market in every region of the country. This is ultimately why they are backing out. So for our analysis today, we actually have to look at the other two line items. So the IMT, the internet media and technology line, which is the majority of it, and then also the mortgages. So the IMT, that's obviously something that they want to grow on. And this is their platform. This is the media platform where they have the Zillow app and everything that has to do with the transaction of buying, selling, renting a house, and every sort of commission or fees that you pay that goes into that line. And we do see not such an impressive growth as for the homes business, but we do see a steady growth here. And we do see strong margins of over 80% here, actually, when you look at that 1.3 billion versus 200 million, 1.4 to 200, and 1.9 to 200 again. So we do see there strong margins in that segment. So I guess for management, it actually made sense to back out of that home business and to focus on the IMT business. But I guess the question that you as investor or as potential investor might have now is, well, if they focus on the IMT business only, is that growth rate there gonna be enough for me to actually generate a decent return over time when I put my money into this company? And so basically what they've outlined here, so the entire earnings presentation was just around the future vision, right? They didn't really go into the current numbers here. Their whole presentation is just about the future outlook and the next sort of 4 to 5 years. So they have outlined the 2025 targets here, which we will soon see I've used in my DCF model. So basically what they're saying is the transactions, they're actually assuming there will be no growth in the transactions amount, which, you could argue that there is actually a growth year on year. But what they are arguing, or what they are planning for, is an increase of share. So currently they're dealing with 3% share of that. They're increasing that to 6%, equaling to 730K number of transactions versus 360K right now. The revenue per customer transaction actually increases, given that, you know, they're assuming a 3% housing growth from 2022 to 2025 consistently, so that they are, basically coming overall from Zillow revenue here, 2.1 billion, which is the current revenue number excluding the homes business, growing to a number of 5 billion by 2025. And then obviously they've cleaned up their margin. So, we've just saw that they actually had a strong gross margin. And then obviously below that gross margin, you would have other costs such as sales, marketing, technology, general admin. And they've actually cleaned up that number for us to understand what would those operating expenses be if the homes business is removed. Because obviously now, even that they want to exit the homes business, they have higher sales and marketing costs because they're trying to get all these homes sold as quickly as possible. So a lot of these expenses here actually relate to that homes revenue, So if we didn't have that, the question is, would the company actually be profitable, and would they actually make a lot of money? And what we do see here in the investors report is, we do say that at the moment they've calculated with a 39% EBITDA margin, so everything after gross margin minus all the operating expenses and before interest, depreciation, tax, and amortization. So there's a decent margin here. So 39%. Not a lot of businesses have that. You can actually compare Zillow with some sort of a form of Google or Facebook, because a lot of their revenue is derived from that platform, and it's just advertising revenue as well, which there's just a higher margin and a good possibility of economics of scale there, because obviously the more users you get on there, the more transactions, the more money you make without having more to spend. That's what I was saying. And then basically their assumption is that EBITDA margin is going to grow from around 39% right now to 45% in 2025. So this is going to be important for our cash flow model as well, as we're going to now actually apply those figures as management kind of promised us, apply to the discount cash flow model to see what the stock price would actually be with those numbers, and to see, is the price at the current levels a deal if management can execute. Coming now to the discounted cash flow model. So what I've done is basically taken what was promised to us in the investors presentation, translated that into the numbers to see what the actual share price would be based on that. Basically management made a 4-year forecast or vision here in that presentation, whilst our cash flow is usually for a 5-year period. So we want to see what is the company generating in terms of cash flow for the next 5 years going forward. So this is what I've done here. So basically on the upper left corner, we have some basic assumptions that I don't want to get too much into. Tax rate, I've applied to 20%. I know that at the moment they don't actually pay tax because of a lot of write-offs and things like that, and a lot of all those homes that they bought basically and operating at a loss there. But like going forward, if we do have that profit coming in, they will have to pay tax. So I'll just assume a 20% rough estimate here. Discount rate 10%, again, is a bit of a rough estimate. We do have that fear of high interest rates, so I didn't want to go too low here. I think 10% is a good mid value. Perpetual growth rate, that is the growth rate at which the company grows forever after their significant growth mode. So once growth has stalled, we do expect it to grow in line with inflation, which hopefully will soon be 2 to 3%. So this is what I put here. EV to EBITDA multiple. So this is the multiple at which your EBITDA number gets calculated for a EBITDA multiple market valuation. That is kind of a tricky one, to be honest. For that, I've actually looked up Zillow's competitors, which is like Opendoor and so on, Redfin, but they all trade at very, very different multiples. It's really hard to actually gauge a right median. So I've looked more into the other communication stocks such as Facebook and Baidu and so on, Google, and they used to trade with a lower of 10%, but I've given given that Zillow should grow a little bit better than the other ones at a higher rate, I've given them a 15 here today for our calculation purposes. And then basically everything else is basically taken from the financial statements that they just released, the Q4 and the full year 10K financial statements. They just released that. So that's all good. In terms of sales numbers, so we've seen here on the left side from the presentation, so the IMT segment has actually generated $1.9 billion of revenue, and then there's some other 200 or whatever it is, 800 million odd other revenue or 300 actually, that gives us the $2.1 billion. And then they've cleaned up that margin for us to see what is the EBITDA margin for the IMT adjusted EBITDA. So it's actually 853 million for that business. So kind of that's what I put in here with the small adjustments for the other revenue that we had there. Then for the revenue, what I found, there's a little bit of a discrepancy here in the report. And I'm not sure if management explained that actually in the investors call. So in terms of revenue numbers, so obviously we've seen that we have now a $2.1 billion, and in 2025 we're expecting $5 billion, which implies an annual growth rate of 24%, as they mentioned it here. But then next slide, actually, they're showing us some historical results. They've basically showcased us here that their IMT business has been growing from 2019 to 2021 on an annual 3-year revenue CAGR, compounded annual growth rate, of around 19% annually. So that basically there's a discrepancy here that they're saying that they either expect increased market growth or whatever they expect, I don't know. But basically there is a 5% difference here in implied annual growth rate, because in order to get me to the 5 billion by 2025, I needed 24%, but historically we've more achieved somewhat around 19 to 20%. So what I've done here is actually applied 19% to be more conservative. So because even 19% revenue growth year on year, I think could be potentially seen as a bit optimistic, but I think that presentation here is way over optimistic. So I think they just wanted a round number, get to the 5 billion. Obviously, they're not going to say, we're going to grow to 4.32 billion. So they wanted a round number, 5 billion, and they just said, we're going to have some other efficiencies that was going to come. So I've adjusted for that, given them a 19% growth rate flat, which you might argue that you should actually reduce in a few years' time. But let's go with that for now. And then in terms of the EBIT margin, which is somewhat similar to the EBITDA margin, because what I did at the end of the day for depreciation and so on, I just kind of net that off and decreased over time, because obviously they will have less and less as they sell their homes, and they are just basically a digital company. So what I did for EBITDA here is actually applying. So at the moment we have that 39% margin. I've applied the 41, 42, 43, 45, because this is what their aim is at 2025. So we're just gonna go with that for now to see how that works out, and then going forward, same 45%. And based on that, all sorts of calculations done here. You don't really have to worry about that, but basically this is the number we're looking at here. So all of this stuff calculates a number which is $37 billion in enterprise value. Then adjusting for the current value of debt and cash, that will give you a equity value of $39 billion. Whilst when you look at the current market capitalization, it's only 14 billion. Adjusted for debt and cash, it's around 12 billion. Looking at the price to sales of 6.5, share price is 55. At the moment, we imply a market value of this here, but our calculation based on what management is promising us, if they can deliver that, we are looking at a share price of 155 with an upside of 100, basically almost triple the amount of what we have right now, as we are looking at a 55 stock price. Upside is basically 183%. So let's say, even if we are a bit more realistic here, let's assume we're only growing at 15% each year, then the numbers you see how on the right side, the lower I take those numbers, the lower this orange bar comes. So it's basically saying that, you know, the lower the growth, the lower the future value, which makes sense. But even then, we're looking at 160% upside because of those strong margins of the IMT business, which is just, you know, over 80% gross margin. And then they can actually say that more than 40% of that comes down to the EBITDA margin, which is, you know, just the margin before that tax and interest that are getting charged. So that's really strong. They're in a strong financial position as such. So I don't expect the interest expense to be a huge issue there. Obviously, tax expense is going to come as soon as they're going to be profitable. Obviously, this is a very simplistic calculation. 2022 doesn't adjust for any other like home sales, admin expenses, and so on. So you might want to adjust that as well to actually bring this down and say, well, the whole EBITDA margin, we're just going to have the half of it. But it doesn't really, matter too much in the end of the day. We're still looking at a huge upside potential for Zillow, given those numbers. If the management is able to execute on those promises, you know, making a few assumptions here over, transaction volume and so on. Obviously, transaction volume annual growth rate, they say, is a 9%. But then if you look at things like this graph, for instance, where they promise you, well, transaction volume is going to go up 9%. Well, actually, we had a huge spike in 2021, which skews the average amount a bit, which might not be that high, might be more in the 5% range if you look at that. So, but basically, this is what you want to look out for now that you need to look at Zillow's financial statements and exclude the home sales numbers from the home flipping business, because that's going to disappear going forward. So actually the next quarter, basically, we're going to see a huge drop in revenue in the next year as well. Like for the annual financial statements, we're going to see a huge drop in revenue numbers. So if you see that, don't be scared or anything or be worried. That's normal. And basically what matters is the gross margin that's going to be actually sticking out as being much stronger, because you have much less revenue, only around 2 to 2.5 billion next year. But that 2.25 billion, if you look at it from a 80% value, you're gonna have a gross margin of around almost 2 billion out of that. So this is very strong. If you can control your operating expenses, then obviously you have a strong cash flow position here, a strong free cash flow going forward as well. And obviously Zillow as such has a strong competitive advantage as well. They've just shown here that, Zillow is more than 3x from their nearest competitors when it comes to daily active app users. So they already have a huge market share. If they want to, focus on that super app here as they are describing it, they have that audience that will maybe respond to that and use that. So that's where they obviously want to squeeze out more profit and more fees from that. So we'll have to see how that goes. And also in terms of the economy, obviously you have to watch some of the macro factors to see house prices, recession fears and so on, interest rates increasing. All of that is not really calculated in here. This is purely from management made their assessment. They promised us this. What does that mean in terms of the stock price? What does that mean in terms of potential upside if that became true? And if you believe in that, you obviously need to do your own research. But if you believe in that, then from that perspective, it looks pretty good. It looks like a strong buy. I mean, this would be a good annual return over the next 4 to 5 years. So hope you enjoyed that. Let me know what you think about Zillow stock, if they are ready for a comeback here today and going forward. And see you next time.